we waited a little bit more than 5 minutes, and it is my pleasure to welcome all the participants, the speakers and the ones attending the seminar or the workshop on tax policy in the post-COVID era, organized by the CFP, the Portuguese Public Finance Council or Board, an overseeing entity of the public finances in Portugal, and jointly hosted by ISEG, the Lisbon School of Economics and Management, of which I am currently the Dean. So unfortunately, we aren't able to be meeting in person in our campuses, but these meetings online are also quite helpful and effective, actually, when we are discussing serious topics like the ones that are under analysis today. First of all, let me say that I am grateful for the CFP for organizing this event with ISEG. In particular, let me thank Nazaré Costa Cabral, the president, and Miguel Santobin, who is also a professor at ISEG. And this is organized at my school, but with the special collaboration of IPP, the Institute of Public Policy, which is coordinated by my colleague and founded by my colleague, Paulo Trigo Pereira, who is also speaking in one of the panels afterwards, and definitely will have interesting things to say on tax policy in the post-COVID era. So my role here is mostly to welcome you all, to wish you a very successful event today, but I would also like to leave a few comments on what's going to happen to tax policy in the post-COVID era. I am, of course, also an economist and a finance professor, not a specialist in public finances, but I think the title of this event today is actually quite optimistic when it talks about tax policy in the post-COVID era. And really the big difficulty we have today is in guessing when that post-COVID era is arriving, right? So we are not really sure whether we are over this pandemic crisis, but in any case, we know that we have already learned a lot about our economies during this pandemic period, with the lockdowns, with the international activity that we've seen. So actually, we already have some trends that we should be considering and think about. One of the things that I think we have learned and we should take into account in our planning for tax policy and public finance in general in the near future has to do with the increased role that the states and the public entities gained during the pandemic crisis, and the need that we all found for the states to fund the economies and to intervene more directly in our economies. So the role of taxation as some sort of equity for companies, for nations, in the same way that companies are able to raise equity, is actually something that is of utmost relevance these days. So what we have seen in the recent years in the European Union is actually that in what concerns taxation, different countries have been following different rules and different choices. Whereas in public debt, in what concerns public debt, we have seen some changes in the way in which the European Union has coordinated these activities more recently. So these are definitely very interesting topics. Of course, if you talk to the common people in the streets, whenever you talked about taxes, people will always be very negative, but actually taxation is one of the most relevant elements of civilization if we think about it. It's something that actually we need to have, and tax policy is very relevant because it's something that allows our nations to share and to redistribute as well some of the wealth that is being generated, hopefully. So these are important topics, and I am sure and very hopeful that with the discussion that we are seeing today, all the speakers will be able to share their views and ideas on the way in which this tax policy should be heading in the years that will come after the COVID crisis. So in terms of recent topics that definitely must be carefully looked into in what concerns taxation, I would definitely not exclude the issues on green taxation or non-green taxation, and how the tax policy can also address the needs to counteract climate change. So that's something that I think is an interesting topic. Another interesting idea that I would like to bring for discussion later is this idea of intergenerational taxation, given the change, not just of demography trends that we have seen in more developed countries compared to others, but also the emigration trends and the different kinds of jobs and work-life balance that newer generations are now experiencing and imposing on us in some way. So that's something that I think tax policy will also be playing a role in. And finally, the other, and associated with this in some ways, taxation, especially if you think about competition, international competition, with different countries being involved in what concerns these new forms of work with remote working, etc. That's also something that should be of serious, the object of serious discussion across countries and entities that deal with tax policy, in the sense that you are working in one country, living in another. How are you taxed? How is the company taxing you? How this world will actually be very different in the future at some point in one nation. And when you are considering the public finances of one country, you are not really sure who your taxpayers are, both individuals and other types of organizations. Finally, and I'm concluding on the topics that I would like to suggest, we also have this big trend of technology developing and entering areas that typically were more traditionally managed. And this happens in finance, for example, with the growth of fintech and all those areas, the big platforms that actually might also be an area of interesting and very much needed work in what concerns tax policy. As we know, a few big players are actually influencing a lot the economies of the world, and the way to properly tax them or make them better regulated is actually also something that should be in the interest of the speakers that will come in the next two panels. So thank you so much. Welcome to the virtual ISEG and CFP. Delighted to be here. I wish you a successful event. Thank you.
Thank you, Clara, for your introduction. I would like to thank ISEG, Lisbon School of Economics and Management, in the name of Professor Clara Raposo, and also the IPP, Institute of Public Policy, from this university. In particular, Professor Patrick Pereira, for hosting and co-organizing this conference with the CFP. This is the second conference the CFP organizes this year within the cycle of conferences that was launched in 2019. The first conference took place in May this year, being arranged with University of Minho and its Research Center on Economics and Management. And the issue that we talked about was specialization and diversification of the Portuguese economy, what perspectives after COVID-19. Now, with this second conference, we intended to gather the best expertise in the field of taxation, which is, as you know, a multidisciplinary area. And so the speakers come from several scientific fields, and to discuss which are the trends and perspectives for tax policy in the after COVID-19, both at the national and international levels, including, of course, the European level. Currently, the world is facing new problems and major structural changes, as it is the climate emergency, the new technological revolution, new sources of poverty and inequality, changes in the labor markets and new modalities of employment, economic disruptions, as it is the value chain disruption. And of course, all these changes will challenge public policies and in particular tax policy. The role of national government and of supranational organizations is also challenged by all these disruptive changes we are living, and that the pandemic crisis has certainly amplified. So it is a pleasure and an honor for the CFP to be able to count with the presence and expertise of well-known personalities coming from Portuguese and foreign universities and other institutions that will, in these two panels of the conference, describe the current state of the art in taxation and of what can be expected in the near future for the design of tax policy. I would like to thank all speakers for their presence here today. Unfortunately, and like initially expected, we were not able to make the conference in a presential mode using ISEG's facilities. I am sorry for that. Once again, the pandemic has not allowed us to be in personal contact, which is always nicer and more friendly. We would have been very happy to host speakers coming from other countries and to receive them in Lisbon. However, despite this setback, we know that all the other important ingredients, starting of course with the quality of the speakers, are combined here today to make this a very productive working session. Finally, but not less important, I would like to thank the audience for its presence here today. I am sure that all of you will benefit greatly from being here with us in this Friday afternoon. Thank you very much. Now I give the floor to my colleague, Professor Carlos Marinheiro, to present the speakers. Thank you.
Thank you, and good afternoon, and welcome to the first panel of this conference. We will have three distinguished speakers that will have 15 minutes to each to elucidate us on taxes, incentives for sustainable economic and social behavior. We will have with us Professor Jorge Kopitz, Professor Eva Ebert-Hartinger, and Professor Patrick Pereira. Professor Kopitz is a visiting professor at Central European University. From 2011 to 2020, he was a global fellow at Woodrow Wilson Center in Washington, D.C., and a member of the Public Policy Dialogue of the Federal Ministry of Finance in Berlin. In 2012-2013, he chaired the OECD reference group on independent fiscal institutions and participated in Peru's Commission on Strengthening the Macro Fiscal Framework. In 2009-11, he served as the first chair of the Fiscal Council in Hungary, elected unanimously by the parliament. In 2004 to 2009, he was a member of the Monetary Council of the National Bank of Hungary. And previous positions include being an assistant director at the International Monetary Fund and a financial economist at the Office of the Secretary of the US Treasury Department. He is currently a member of the Senior Board of CFP. Professor Eva Ebert-Hartinger is a full professor and holds a chair in business taxation at the Department of Finance, Accounting and Statistics at Vienna University of Economics and Business. From 2006 to 2011, she was vice rector of financial affairs at Vienna University. And prior to her position at Vienna University, she was a full professor for business taxation at the University of Münster, Germany. She held visiting positions at University of Exeter, at University of Urbana-Champaign in the US, also in EAC Paris, France, McGill University in Canada, also again EAC but in Montreal, Canada, the University of Malta, and Macquarie University in Sydney. And we will have also with us Patrick Pereira, who is a full professor of public and welfare economics at ISEG, Lisbon School of Economics and Management. He graduated at ISEG. He has also a master in sociology and economic history from Nova University, and a PhD in economics from Leicester University from the UK. He has been chairing the Master of Economic and Public Policy and teaching public finance, institutional economics and law, and economics at ISEG. He is the author of several books on Portuguese public finance and institutional economics, and he has also published extensively in social choice, public choice, and electoral studies. He has also been a visiting researcher or scholar at several universities in Netherlands, London School of Economics, Leicester University, Turku in Finland, New York and Yale universities in the US. And apart from academia, he did some consultancy for the Portuguese government on regional and public finance, as well as the reform of the state. He has been leading civil society projects on budget transparency in Portugal, and he has a regular presence in the Portuguese media. He was also previously a Portuguese MP. He is also co-founder and president of the board of the Institute of Public Policy, who is co-hosting this event. So I will give the floor to George. Each of you will have 15 minutes, and I will ask for you to make a spare use of the time that we have. Any questions that the audience might have, please put them in the chat if we have some time for discussion. It will be more practical than to. So I will give the floor to George Kopitz. Please, George.
Thank you, Carlos. It is really a pleasure to participate at this brief conference. I think that it's certainly timely, and it is a pleasure, even though I cannot be with you right now, but I'm sending you my very best regards from Virginia. Let me just start by mentioning that this is going to be really brief. There is a PowerPoint with considerable references, but I will be rather superficial for some of you, and I will try to rise to the challenge. Now, what I'm going to actually do is start with the challenges that we face in this post-COVID era, and I think that could be useful also as a backdrop to this presentation as well as other presentations. And then I will do a survey, a quick survey, the taxonomy of taxation and its impact on behavior, on various aspects of behavior, various types of taxation. And then I would like to close with implications of what we know about the impact of taxes, the effect of taxes on behavior, the implications of that for the challenges that we face in this post-COVID era. So let me share. Okay. So that's the topic I'm dealing with, and the outline is right here, the challenges, and then taxation of capital, labor, personal income taxation, selective excises, or if you wish, specific rate taxes on commodities, and then what we can regard as distortionary taxes in their totality, namely income, property, and labor, and then the implications, right? So what are the challenges? Ongoing and future pandemics. Just remember that we have plenty of letters in the Greek alphabet between Omicron and Omega. So I think it would make sense to really anticipate future pandemics. Aging, of course, decline in the productive labor force that to some extent, of course, can be and is being compensated with immigration. And then inflationary pressures, which are not going to relent. If we look at Goodhart Pradhan in their recent book, this is due to a large extent to the compression of the labor force. On the one hand, with aging, the greater demand for goods and services, and fewer smaller supply of labor. Deterioration in fiscal sustainability, it's not only in Portugal, of course, but almost worldwide. The rise in interest rates, including risk spreads, particularly as the very liberal, generous liquidity emission by central banks is tapered and eventually over, I hope. Secular stagnation, which we feel it in rather lower than desired growth of potential output over time. Climate change, of course, and high international mobility of capital, mentioned by Professor Raposo. Capital, through the rental cost of capital derived from the neoclassical theory of the firm, we have the effect on investment and particularly its impact, the simulated impact of US investment tax credits, which was introduced by the Kennedy administration way back in the 60s. And here we have the seminal piece by Holland Jorgensen. Then the effects of multinational corporate financial flows. It's something that I researched on the impact of differentials on dividend remittances and royalty remittances. The effect on employment, which is really labor supply, right? Estimates of payroll tax and simulation of France's prime d'incitation à la création d'emploi. It's a subsidy, really a marginal subsidy, targeted subsidy in the 70s. And a whole number of such subsidies in a number of countries, but Italy stands out as having experimented with this over time with employment tax credits, for example. The authors are really authors of works in this area, estimates and simulations, and it's really significant estimates which are statistically significant for the most part. Here we have the effect of personal income taxation, researched early on at the time when the Laffer curve came into fashion with a two-sector general equilibrium model of households. It was interesting, especially from the standpoint of Sweden, that had very high marginal income tax rates rising from the 60s all the way to the 70s. And Charles Stewart found that the Laffer curve indeed kicks in at about 70% marginal rate in Sweden. And then we have the selective excises that we talked about. These are specific rate excises rather than ad valorem on such commodities as tobacco, alcohol, fuel excises, and there are a number of studies on this. I didn't really do a thorough survey of the literature, but even without these estimates, we know that the consumption of these products makes sense from a Pigouvian standpoint, have the desired impact on the consumption of these products, which affect health in a negative way and also have their externalities onto others in society. What, of course, is of timely research is the effect on carbon abatement of such excises and possible incentives. There have been a number of estimates recently, and they're growing. I'm sure there are a whole number of PhD dissertations being written at this time on the effect of carbon taxes on carbon emission. Indeed, that has a desirable impact. The rates really vary quite a bit over a number of countries. The champions in this area are the Scandinavian countries, Norway, Sweden, Finland as well, possibly Denmark. I don't have in front of me the countries, where the rates go up to $100 a ton of carbon emission, and then that ranges down to about zero in the United States, where this is really something that is considered taboo, even in the policy making, in the White House, in Congress. Nobody would want to touch with a 10-foot pole, as they say here in Washington and in Northern Virginia. Nobody would want to touch with a 10-foot pole a carbon tax, okay? Even though economists, right and left, would all agree that that's what we need, if in fact there was less blah, 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 to quote a very famous young activist, and indeed there was more courage, at least on this side of the Atlantic, and in some European countries as well. What, on the other hand, business really loves, and there is no end to this, is the effect of tax credits on carbon capture. There is the famous 45Q section in the US tax code, which provides such tax credits for companies that actually engage in carbon capture and invest in projects that take care of that. Now, this is very difficult to monitor, actually, and obviously it has it can have an impact on the budget. Finally, we have a study based with estimates based on endogenous growth model, which I highly recommend to anybody actually dealing with public finance. There have been a number of sons of these studies, and it's really a cross-country time series panel estimate, which looks at the range of taxation as well as expenditures on per capita growth. Non-distortionary taxes, such as the value-added tax, have no significant impact, but we see that income taxes, payroll taxes, property taxes, which we can regard as distortionary on household and corporate behavior, such taxes do have a significant negative impact on per capita growth. In the context of this model, which is something that we would not be able to capture these sort of effects in the context of the textbook familiar neoclassical growth model, except indirectly, very much indirectly, through by tracing effects on investment and labor force participation and innovation. Implication for the post-COVID era, on the basis of what we know from the literature, targeted incentives, tax credits, or outright subsidies, for example, should be very helpful for growth if it's targeted to investment in research and development. I would argue that these would have to be rather generous incentives in their magnitude. They would, of course, encourage technological innovation. Targeted incentives for hiring and training in the form of payroll taxes, tax credits, etc., certainly should be helpful for employment and growth as well. Cuts in distortionary taxes, the range of income, property, and property I would put at the very end of it, but certainly in income taxes at the proper range, because mind you, there is this is not a linear relationship. Increasing the income taxes as they rise have a higher elasticity, negative elasticity with, or rather below 1 with respect to taxes, and then they become negative if we believe in the study in Sweden, but we are not in those ranges. Taxes on carbon emission, tax credits for carbon capture should definitely help mitigate climate change. This is an area that one cannot just say a stick or a carrot, but rather both sticks and carrots are relevant here. One aspect which I could mention as a minor one, I saw a survey, a research done on survey on the effect of fuel taxes and carbon taxes. Interestingly enough, particularly fuel taxes, if the individuals or the households feel that these taxes are earmarked towards expenditures on mitigation of carbon and carbon emission, then indeed it will not really depress consumption of fuels, because people feel that the revenues from this tax are going to the right direction. They are green taxes, and therefore no reduction in consumption can be expected. So it's an interesting feature that would merit some more research. Finally, worldwide minimum corporate tax on a uniform base, and this applies also to high-tech companies. There has been a step forward in this direction, namely of agreeing on a minimum tax of 15%. One problem, of course, is that, well, first of all, I think this might be a little bit too low, but it's good for starters. But what's missing is any attention to the base of the tax, which can be critical. As we all know, in corporate taxation particularly, the base of the tax is open to all kinds of manipulation, and it's anything but uniform. Not even in the context of the EU, a step has been made really to establish a homogeneous base. Here, of course, the gains from this would be allocative efficiency across countries and eventually growth. Thank you very much for your attention. Here's a list of references that can be perused. Thank you very much for your attention.
Thank you very much, George. So I will now give the floor to Professor Eva.
Thank you very much. So before I start sharing my screen, I would like to thank you very much for inviting me to the conference. I'm very honored, and it's a great pleasure to be here. And having said that, I'm now ready to share my screen. So there we are. All good?
Yes.
Okay, thank
Perfect.
you. So I would like to continue really where George, or pick up where George left us with a general overview and zoom in on one specific aspect, which is the role of tax administration. And let me start this way. In a post-COVID era, budgets in all countries, in the European Union especially, but also in other countries, budgets are even tighter than they were before. And one possibility, obviously, to work on the budgets is to increase the tax revenues. And to increase tax revenues, you can invent new taxes. Carbon taxes would be a way. Or in Austria, for example, we have no wealth tax, no inheritance tax. So you could think about those things depending on your values. And or you could work on existing taxes and increase those, increase the rate and increase the base. Or you could just take the taxes as they are and improve the tax collection. And just a second. And therefore close the tax gap. And this is where I would like to zoom in my presentation. The role of tax administration in that respect. There are, of course, other roles as well, but I would like to focus on tax collection aspects in order to improve or to raise tax revenue in a post-COVID era. Now, the tax gap really is anything, the difference between what the tax revenue should be and what the tax revenue actually is. And I'm sure the audience here is well aware of that. It consists of tax that may deliberately not be paid because of tax evasion in the worst of all cases, or tax avoidance, or it might be tax that has not been paid because of error or mistakes or complexities of the tax systems or whatever. The tax gap itself is hard to measure. There are different ways to try, bottom up or top down. That's not the focus of my talk. You could discuss a lot how to quantify the tax gap. What you're left with, even when you consider all the weaknesses of the different methods, you're left with the impression that there is still a lot of tax out there that should be collected, that is not paid, even though it should be paid. So what do tax administrations do? Tax administrations have developed considerably during the past decade, I'd say. So they have considerably improved their data collection and their data control. Also, the BEPS project of the OECD and its implementation in the European Union has added to that. Tax administrations have improved their, or have digitalized and have offered services such as e-filing, which is in place, which has been in place for a long time in almost all countries. I found on the internet that Portugal has been implementing a mobile app for taxpayers. Austria is about to do so. Also, pre-filling of tax returns. The blockchain, of course, quite many tax administrations worldwide are trying out, having use cases with the blockchain. There's a long list of that. I'm not focusing on it, but for example, Finland is working on real estate tax together with banks on the blockchain or other use cases. I would like to focus more on the digitalization of tax audits. So tax audits based on artificial intelligence, or on algorithms, or on pre-auditing measures, or on the standard audit file tax, which is a way of standardizing and digitalizing an ex-post tax audit that is carried out. And then there is the aspect of cooperative compliance, which most of you are probably most of you know about, which is an approach of the tax administration vis-a-vis the taxpayer or the firm, the business, a more trustful approach. And instead of conducting ex-post audits, sometimes many years later, you would have an ongoing trustful relation, have complete transparency, exchange reviews, and have timely certainty on your tax liability. And that certainty is crucial in this regard. Tax administrations also have intensified their cooperations with tax administrations of other countries, and also universities, especially, for example, the Tax Administration Research Center of Exeter University has have started to do more research in tax administration. That is an area or a research focus that has only developed during the past, I'd say 10 or 15 years more intensively. And there's still a lot to do in that area. And also our research group at Vienna University of Economics and Business, we try to contribute. So as I said, I would like to zoom in on the digitalization of tax audits and on cooperative compliance. And I would like to emphasize or give you some more information on how the way of interaction or the way in which tax administration approaches the business, how that affects the business. How would they respond in their behavior? And there are three research projects especially that I would like to draw your attention to. One is on risk-based tax audit, the other is on e-audit, and the third is on trust relationship between tax administration and firm. So the first one, are risk-based tax audit strategies rewarded? So what we do is, in a cross-country study, we analyze country-specific OECD data on risk-based audit, tax audit case selection, and we use specific advanced ways to select the cases, especially risk profiling, predictive modeling, and internal intelligence functions. So the digitalized AI ways of selecting audit cases. And what I will not go into all the details, let me jump to the results. What we find that risk-based tax audits are associated with reduced tax avoidance, meaning that in countries where risk-based tax audits are carried out with those features, with those advanced features, as I call them, in those cases, you would find less tax avoidance, and that tax avoidance is measured as the effective tax rate that is displayed in the income statement of the firm, of the group. And surprisingly, we find that effect for firms of all sizes, also for large firms, because you could argue that large firms are audited on a continuous basis anyway. They have continuous tax audits in many, many countries. But still, even then, you would find reduced tax avoidance. In addition, we did some additional tests. We also find that risk-based tax audits are associated with a reduced cost of enforcement for the tax authorities and with an improved performance of tax authorities. And we have specific measures for that. So basically the result is that an investment of countries in advanced and more IT and AI-based risk-based audit case, tax audit case selection is advantageous not only in improving their own efficiency, but also you would have firm response. They would reduce the tax avoidance. The second study I would like to draw your attention to, the future of tax audits. I'm talking here about not the normal ex-post audit that you might have 5 years or 10 years or maybe even 15 years later, but instead, especially for micro entities and for small entities or maybe also medium-sized entities, they would in real time upload their micro-transactional data to the systems of the tax authorities. Their systems would run statistical and AI analysis. Any outliers would be clarified, and then you would have immediate and automatic assessment. In cooperation with the Austrian Ministry of Finance, we analyzed which features such online automated tax audit would need to have to meet acceptance from businesses and from tax auditors. And the 4 potential features that we looked at were data privacy, audit certainty. So the promise that you would never ever be audited again on that particular year, transparency, and you don't need a tax consultant. You don't need an intermediary to do that, independence. It was an experimental survey with business taxpayers and tax auditors, and the results are really, really nice. First of all, we find exactly opposing views between taxpayers and tax auditors, like exactly opposing views. And the one thing that really matters is audit certainty. So it's audit certainty that is important. And the taxpayers would accept, cautiously accept, and trust the tax authority if audit certainty were connected to that type of audit. And they would still perceive that tax administration is in a powerful position, whereas opposite, tax auditors would not support such automated tax audits, and they would perceive a substantial reduction of their own power if they were never allowed to audit that a specific year. And in additional analyses, we found that it's not really fearing for losing their jobs, but it's rather fearing for the correctness of the results. Okay, and the third research project I would like to highlight is the role of trust. Your cooperative compliance, like the trustful relation between tax authority and the business taxpayer, complete transparency, clarification of all tax issues in advance, and connected to tax certainty. Like, yeah, all is clarified right now, no later tax audit. You need trust. So the question is, what if you're in a bargaining situation and you do have bargaining situations on tax matters quite frequently? And how would interpersonal trust between the taxpayer and the tax auditor on the one hand, and both individuals' trust in the government on the other hand, how would that affect the bargaining situation, like the concessionary behavior of the individuals? And that was an experimental study with student participants. And the results are twofold. First, trust does affect concessionary behavior. Trust in government, the results are as you would assume. If you trust your government, taxpayer concedes less, is willing to pay more, and the tax auditor is willing to collect more. And for interpersonal trust, that only affects the tax auditors. So a tax auditor might be inclined in specific circumstances to be a bit more lenient if interpersonal trust or if he has a trustful relation to the taxpayer. So let me come to the conclusion. The tax policy also post-COVID, not necessarily only post-COVID. Really, this would extend in a non-COVID situation as well. You would feel, you would like to seek possibilities to close the tax gap. And the thing I would like to clarify or highlight, the audience here knows that anyway, it's not all about tax evasion. Like many taxpayers, also firms, they would just like to pay their tax. Tell me what I need to do and I pay my tax and don't bother me with it again. So it's not all about tax evasion. And from those three cases, countries should invest in risk-based, should invest more in advanced risk-based audit case selection. I think it would be useful to offer trust-based e-audit to micro entities and therefore offer them an easy way to pay tax. And other research shows it's particularly them who are prone to errors and mistakes. Offer tax certainty in that context. However, be careful with too much trust, because interpersonal trust of the tax auditor in an audit situation might be not useful. And beyond all that, I would find it quite useful if tax administrations, and they are starting to do that, some are quite advanced in that, if tax administrations would start to consider behavioral insights, also for businesses, also in a setting where you think you have a more rational behavior, but still it's always individuals who decide. And there is also for businesses very interesting research out there on tax auditors, on the reaction of businesses to the result of a tax audit, whether there was a finding or not, yeah, etc., etc. A lot of things to say. Thank you very much for your attention. And please let me know whether I should take any question from the chat now or later.
Thank you. No, there is no question from.
Oh, there is no question. I just saw that little.
No, it was just a reminder for that you had 5 minutes, but you have complied very well with your time. We are behaving very well in this virtual setting. So I'll now give the floor to Patrick Pereira, and but if there are any questions that the audience might have, please put them in the chat for us to share it with our guest speakers. So, Paulo, the floor is yours.
Good afternoon, everyone. I would like to start thanking CFP in the name of Professora Nazaré Costa Cabral and Miguel Santobin for having invited me to participate and accepting this collaboration of IPP in organizing this conference. All my colleagues in the panel as well, and the audience. I'm not a specialist on environmental taxation, but well, I had an invitation from Miguel, and I said, well, let's put together some thoughts about this. I only teach now a course on sustainable development. So what I will try to do, it will be difficult because time is short, but it's to talk about taxes, incentives, and markets for economic and social sustainability. I would like to have time for all this. So I'll start with the objectives of policy and the trade-offs in terms of these objectives. I'll speak a bit about the policy instruments. Then I will go quickly to the concept of what is an environmental tax. And then I will move to the European Union approach to environmental taxes and markets and incentives. And I'll finish with Portugal, with some empirical evidence also and some conclusions. So, as you know, the EU has, and the member states have very ambitious objectives in terms of the Green Deal agenda. So reduce 55% the emission of greenhouse gases until 2030, and to attain carbon neutrality in 2050, which does not mean that there are no emissions, but it means that the emissions will be identical to the capture of carbon. So this is a very ambitious objective, to have climate sustainability, which means that, you know, the increase in temperature will not go above 1.5 degrees or maximum 2 degrees. But all this discussion, and this is something that makes me a bit not confused, but I don't see much of this discussion related with the trade-offs that exist with, you know, economic sustainability and social sustainability. So, of course, we have this important objective, but we have to address, and this is one of the main topics of my my presentation, that there are important trade-offs. One in terms of economic growth, another in terms of inflation, And another one in social terms, because as we know, and George spoke about, the excise taxes have a regressive impact. So we have to address these potential trade-offs when discussing policy and environmental taxes. And there are two additional problems. These for sustainable public finance is that carbon taxes, if they are correctly designed, are quite volatile. And another problem is that if environmental taxes are successful, they will erode the tax basis and they decrease the revenue. So if the idea is to get also the double dividend to have an extra revenue, this should be considered. Let's just say 2 or 3 things about these trade-offs. In terms of economic growth, there is a problem that is being discussed in the European Union, and it has to do with competition, international competition. It's called carbon leakage. If we in the European Union are very strict in terms of regulation, of course, some industries will relocate outside the EU. And so one of the proposals of the European Commission now is to create a carbon border adjustment mechanism. As I'll mention in the end, without this carbon border adjustment mechanism, which is basically this idea that if some goods are imported to the European Union and they have a carbon content, and if the industries located in those countries, those third countries, did not pay a carbon tax, they will have to pay it entering into the European Union. So this is essential for the success of the European Union trading emission system, because otherwise we are, increasing regulations, increasing the price of carbon, as I will show in a few moments, and of course this will have a problem in terms of relocation of industry outside the European Union. The other topic, which is not very much discussed, but we feel it already, is that decarbonization, I believe it will lead to inflation. Because unless there is a strong technological progress in terms of the renewable energies, or energy will become steadily more expensive, and this will lead to inflation during the forthcoming years, 10, 15, until we reach the point of decarbonization. And the third point, as I said, is that excise taxes have a negative social impact. And this is already being addressed in the EU and in Portugal as well, with the so-called recycling of environmental tax revenues, which is basically earmarking revenues to environmental funds or social environmental funds, who then can have several measures like subsidizing public transport, as it was the case of Portugal with the Fundo Ambiental. And it's also discussed at the European Union level with the European Environment Social Fund. So the other thing that I would like to bring today is that when we address climate change and policy instruments, we cannot concentrate only on environmental taxes. And why? Because there are non-environmental taxes that we can have reduced rates, like reduced VAT rates, to stimulate the use of solar panels, the use of renewable energy, and VAT is not an environmental tax, but is the major source of revenue in most countries. So tax expenditures also play a role on this discussion. And another thing that is not taxes, which is basically a market for carbon, and the EU was pioneer, and it's a good example worldwide, cannot also put aside, because some taxes are, as I will show, some taxes are indexed to the price of carbon in the EU emission trading scheme. So at least, even if we don't speak about regulations and subsidies, at least even in the field of, let's say, environmental taxes and similar things, we have to talk about these three things. We have to do and have a huge impact on decarbonization. And so basically the issue that was very interesting to discuss, but we will not have time to do it, is to understand how cost effective are these instruments towards decarbonization, first question. And the second question is, well, let's look at the impact, not just on decarbonization, but on other economic and social policy objectives. For instance, the EU emission trading scheme is considered very cost effective, because basically we created a market and license to pollute go to an auction and to those who offer more. So in terms of the economic impact, it's a very good and cost-effective way to reduce pollution. We reduce pollution with the lowest economic impact. But how it will affect other objectives of economic and social policy, we should discuss this as well. So basically, we have the approach of tax emissions or a proxy of emissions, and this is also a problem for tax administration. And the other approach is to create a market where the price basically is set by a supply which is kept, so there is a fixed maximum amount that is defined by the European Union, and the way we decrease emissions is that this cap is decreasing year after year, and this supply faces a demand, and we have now a market, and we have a rising price of carbon that I will show you in a while, just to make a question whether taxes can be indexed to the carbon price or not. When we look at what the EU countries do, they do lots of things and different things. Some countries use a proxy of carbon emissions in transportation, which is the case of Portugal. Portugal does several things, but some countries use only a proxy of carbon emissions. So if you tax a liter of petrol or diesel, you are not taxing emissions, you are taxing something which is related, but it's not emissions. Other countries try to tax emissions directly. Most countries are in the EU ETS system and receive revenues from carbon pricing. And other countries index the carbon tax to the price of carbon in the market. So we have several ways to deal with our problem. I will not lose time. This is an important topic, but I will not lose time with this. Just to say that Eurostat statistics are bundled in these four categories: energy, transport, pollution, and resources. But energy contains carbon taxation, and pollution does not. This this is something that is being discussed at the European Union level now, and perhaps it will be changed in the near future. But it's very important, I assume, that statistics on specifically on CO2, when they can be devised, are provided to have better policies. But I cannot lose much time with this. Well, in the EU, more than 2/3 of environmental taxes, 3/4 come from energy taxes and transport fuel, particularly. And as I said, Commission, is making an assessment of the executive practice to reduce greenhouse gases, and it is considering to change this sort of statistics. But I will not change very much about this. I'll move to the main measures that are being implemented. So there is a big ambition by the European Union. Here is just a set of what is so-called Fit for 55 package. So basically it's a set of legislative proposals and policy initiatives that aim this reduction of 55% of greenhouse gas emissions. Some are regulations, as you can see. Others are have to do with taxes. And even this week, we had a decision by ECOFIN that approved changes in the VAT directive, in the tax rates, which will create, they have some advantages, but they are very risky in the sense that, as we know, in every country, there are lots of lobbies to have, reduced VAT rates or super reduced VAT rates. And now we can have exemptions, we can have rates below 5%, which was considered to be the reduced rate. And this, of course, can be used in environmental taxes or in non-environmental taxes, but in goods that have an environmental impact. Good. So this is the positive side of this flexibility. The negative side is that we are eroding the tax base of VAT. And as it was said before, we need to get more revenues. There is a fiscal gap and there is fiscal evasion. And on top of that, now we have the possibility, or we will have the possibility to have several, I believe that the 2 below 5, 0, 2 below 5, 5%, intermediate between the 5 and the normal tax rate of the country. So I don't know, I'm a bit skeptical about this, move. Important things here, as I mentioned, the creation of a carbon border adjustment mechanism is essential. Without it, because what is happening now is that with European trading system, is that, and I have two slides to show you, the price of carbon in auctions. So in the beginning of the market, a vast allowance of licenses were given for free. So, and auctions were very limited. Now, each time auctions are increasing. So this shows from 2013 to the beginning of 2020, and the price was around 30 euros per ton of CO2. And now look at what's happening on the last months. So the average auction clearing price of carbon in the EU market is now above 61 euros per ton. So, of course, there is this important question, can we use the price of carbon for taxes in sectors outside the EU ETS market or not? Because this is much more volatile, and this is the reason why countries like Portugal do not use only a carbon tax, and carbon tax is, let's say, 1/10 of petrol tax. Okay, just a few comments because I think I should be reaching my time.
You must finish, please.
Brief comments on the Green Deal, and then 2 or 3 comments about Portugal. The Green Deal is very ambitious. We should not forget that decisions on taxation, according to EU treaties, have to be taken by unanimity, which means that it will not be easy to reach some consensus. Emissions trading system cannot be implemented without the carbon border adjustment mechanism. And it's very important, this measure of the Social Climate Fund, because without it, the social consequences of this, decarbonization of the economy will be dramatic. So we should address this very carefully. And I've mentioned already that this has been eroded. Okay, a brief words about Portugal. Portugal is using all the instruments that are that I mentioned before. We have environmental taxes regulation. We have a participation of revenues of the European Union market of carbon. We have subsidies and tax expenditures. Actually, the weight of our environmental taxes is above the European average. It represents roughly 10% of central government tax revenues in 2020. Basically, from 3 different taxes. The first one is one on the liters of petrol and diesel. So it's not on emissions, it's the biggest one. Actually, we don't have statistics, and it's not in the budget. One tax, which does not appear here, it's not in the budget, and it's not in the budget execution, but perhaps the Conselho das Finanças Públicas can do something about this. A tax that I'll mention in the next slide about the carbon tax. So we have basically a tax that is based on the purchase and registration of a vehicle, ISV. We have a tax on annual property tax on vehicles, let's say on mobility tax. And then we have the excise tax on petrol and diesel. Actually, we created in 2016 something called, and this is not in the statistics, this is not in the budget in an autonomous way, because it comes within ISP. So it's called additional to the ISP, but it's a tax completely different. The tax base is different. This is a stricto sensu carbon taxes that tax what we may consider a proxy of the marginal social cost of carbon given by the arithmetic average of the price resulting from the EU auctions in Portugal. It's roughly 1/10. In order to know how much was this tax, I had to go to the regulator and see the price of a liter of petrol, and there it is what is the carbon tax. But you cannot find this. At least I hope that someone here from the Conselho das Finanças Públicas can tell me, because I could not find it anywhere. And this is the only carbon tax that exists really on carbon. There is also an important point, and I move to the conclusions, that we do some recycling of environmental taxes in Portugal. We have an environmental fund, Fundamental, which is a merger of several funds that existed before, the Portuguese Carbon Fund, the Environment Intervention Fund, and two other funds. And the major expenditure, for instance, of this environmental fund in 2020 was subsidize the prices of, buying tickets for metropolitan transport. So it's a way of aiming and implementing, double dividend again, decreasing greenhouse gas emissions and social sustainability, because people who more use public transports are low-income people. To conclude, well, there are lots of conclusions, but I will just summarize the more important ones. From my point of view,
because we have here a question.
We need good and accurate information and statistics, and we need to address the trade-offs between, decarbonization on the one hand, social sustainability on the other hand, and economic development on the other hand. Well, thank you for your attention.
Thank you very much. Unfortunately, we are entering into the time reserved for a small break. There was one question from Pedro Rodrigues regarding the use of taxes as an industrial policy. And I believe that the presentation we had here has just shown that we use the tax system to try to reach several goals at the same time, and some of them are in contradiction with each other. But unfortunately, I believe that we must go into to have a small break and to resume on the hour. Hello again, and welcome to the second panel, where we will talk about equality, social justice in taxation at national and at international level. We will have three guest speakers. Simeon Diankov, who is a policy director of the Financial Markets Group at London School of Economics, as well as a senior fellow at the Peterson Institute for International Economics since April last year. And prior to joining LSE, was a senior director of development economics at World Bank from 2019 to March 2020. He was also Deputy Prime Minister and Minister of Finance of Bulgaria from 2009 to 2013. And prior to his cabinet appointment, he was Chief Economist of Finance and Private Sector Vice President of the World Bank, as well as Senior Director for Development Economics. We will have also with us David Bradbury, who is the head of Tax Policy and Statistics Division of the Center for Tax Policy and Administration at the OECD. David joined the OECD in April 2014, where he leads the team of economists, lawyers, and statisticians who are focused on providing internationally comparable revenue statistics and delivering high-quality economic analysis and tax policy advice. Prior to joining the OECD, David was a lawyer, a member of the House of Representatives in the Australian Parliament. He served as well in the Australian government as the Assistant Treasurer, Minister for Competition Policy and Consumer Affairs, Minister Assisting for Financial Services and Superannuation, and Minister Assisting for Deregulation. And we will have also with us Ana Paula Dourado, who is a full professor of tax law and international and European tax law at the University of Lisbon, and director of the Center for Research in European Economic, Financial and Tax Law, and editor-in-chief of the global journal Intertax. She has been a visiting professor of several European universities, including the University of Florida, the Ministry of Finance in Taiwan, and the African Lusophone universities. She is a founding member of the Group for Research on European and International Taxation, and she has crafted and negotiated reforms in Portuguese-speaking countries as an expert at the Legal Department of the International Monetary Fund since 2003. And also, she has also been an expert on tax reforms and direct taxation and tax procedure for Timor-Leste government from 2015 to 2016. She was a member of the Center for Tax Studies at the Portuguese Ministry of Finance, the delegate for Portugal into working groups for direct tax harmonization at the European Community, and into working group for tax avoidance and evasion at the OECD. She is a member of scientific boards of several tax journals and a member of several academic committees, and her research interests and publications focus on international, European and comparative tax law, international tax justice, constitutional and fundamentals of tax law, procedure tax law, and direct taxes. So with these distinguished guest speakers, we could now start our second panel. Each of you will have approximately a quarter, 15 minutes to 18 minutes in order to make their presentations. And I start to give the floor to Simeon Yankov, please.
Thank you very much, Carlos, and good afternoon from the United States. Like George, I'm in Washington, D.C. So good to have this conversation across the Atlantic on a topic that is taxation and the social issues around taxation that has certainly become a lot more topical over the last couple of years with the COVID pandemic and more recently with the discussion around the OECD proposals on corporate global taxes and how would you go about it, which no doubt were certainly spurred by the effect that COVID has had on a number of types of workers, employees, and in general, the distribution of taxes. So I would like to talk about three types of taxes and then give some thoughts on their social dimensions. Environmental tax, where a number of people already spoke about, including George gave a very good overview also of what's possible in the United States versus Europe. So just touch a bit on that topic. Then I'll talk a bit about direct versus indirect taxes and the trend towards more and more indirect taxation. And then the issue with labor taxes. This is some topic that became very prevalent during COVID, as we saw that many struggling businesses laid off workers, even in the presence of furlough schemes and other job retention schemes, simply because labor taxes, direct labor taxes were so high. And hence, something that governments have been considering how to change may speed up. And lastly, which is my main expertise, I will talk about the global corporate tax proposal at the G7, G20, originally by the OECD, which is very related to the global digital services discussion and taxes, and how, in my view, this will develop and what it means for social inclusion, social inequality. So let me start with environmental taxes. These were already discussed in the previous panel in quite a lot of detail. So let me just make two additional points. The first point is that while we have seen now quite a significant proliferation of different ways to tax with a view of achieving the Paris Accord climate agreements by 2050. The gap between what is now collected in terms of taxes and what are the private investments outside of these taxes and what is supposed to be our path to 2050 is very significant. So in particular, the calculations by finance economists, including our group at the London School of Economics, suggest that every year we should be investing between $5 to $11 trillion in order to meet by 2050 the goals written and committed by a number of countries, nearly every country around the world by 2050. Currently, for the last couple of years, even before the pandemic, we had between 600 billion to about 800 billion a year. I'm talking about global investment. So in other words, we are, depending on how you look at it, between 7 to 15 times shorter than the goal that we have each year to meet these investments. And the reason I'm saying this is that means that sooner or later some additional taxes will have to come from on top of the environmental taxes that we have now on energy, on transport, on some other sectors in order to achieve this goal. But as our previous speakers rightly mentioned, the way that current environmental taxes are set up, mostly as excise tax on fuel, on some other, on energy more generally, on airport fees, on some other logistical transportation, in essence, they are regressive. In other words, they impose more burden on more socially problematic groups, weaker socially groups than they do on the average population. So clearly, as we are thinking of what other taxes or what other ways governments have to collect more money to meet these environmental goals, we also need to be very cognizant that the current system of environmental taxes generally punishes the socially weaker part of the populations. So this is one point that I wanted to mention on environmental taxes. But the one that is more worrying is that we're very far from equilibrium on environmental taxes in terms of the level that it needs to be achieved in order to meet the Paris Accord agreement. So a lot more, in other words, is coming our way, and hence it's very good that this previous panel and perhaps our panel is going to focus more on environmental taxes. The second point was on labor taxes, something that was not yet discussed in the previous panel, which there is a long and distinguished academic literature in public finance on direct versus indirect taxation, and especially the labor part of it in many countries, particularly in Europe. Labor taxes are quite substantial, which creates problems for first-time workers, people who are just coming to the labor market, for people who have less education and are trying to stay on the labor markets. And also, as we've seen during COVID, and this is my main point here, especially for women, who, because of the COVID pandemic, in many cases had to stay home to get even bigger burdens of family care because of children, because of parents, and so on. And we saw in a number of countries where women's unemployment or non-participation in the labor forces spiked up, in part because of very high labor taxes. So this is one other direction that a lot of academic literature shows the effects of labor taxation, particularly for these more vulnerable populations. Yet not much has been done, particularly in Europe. One of our next speakers has rich experience in Australia, so maybe he can comment. I think this is one country that has done a lot of work in this and successfully in this area. And Carlos, my third and final point is on global corporate taxation. where I have done quite a bit of work over the last 10, 15 years. As you well know, the OECD has worked for many years, more than a decade, to have a proposal which was sped up in the last year or so through approval by the vast majority of countries around the world. COVID helped, certainly, in that regard. The realization that something has to be done to collect more taxes and meet the large fiscal burdens or fiscal needs due to COVID. But also the change in the US administration, as the previous administration, Republican administration here, was very clearly against any global corporate tax deal or discussions, while this administration, Biden's administration, has actually been one of the main proponents of this idea. But more specifically to social inequality and our discussion today, let me just make the point that the spirit of this proposal goes exactly in the direction of reducing social inequality through this global tax, which essentially will equate at the bottom, would have a minimum global corporate tax, so that there are no tax havens, or at least they're punished if you operate there. But also will collect additional resources, mostly through global digital companies, think Alibaba, Amazon, and so on. And through a fairly complex mechanism, at least at this point, will redistribute them to different countries in a way that hopefully will increase social equality. As I mentioned, this is a lofty goal. A lot of work has been done, both by the OECD and a number of other governments. The French government, in particular, French Treasury, has made major contributions to this area. But let me just finish on a note of skepticism of how fast we will move in this direction. And this skepticism is in two directions. First of all, to note that globally, we have never had a global tax convention or tax treaty, even though even in the last century, in the 30s, for example, the UN tried to do so, and there were a number of studies, a number of very prominent scholars contributed to them, but it is difficult to have a global tax convention, particularly in the direction of equating taxes. Hopefully we succeed this time. Certainly the pressure is there. But while the US administration has changed, the US Congress hasn't substantially changed their view on the United States and whether they'll participate in such a global treaty. George mentioned himself that he's very pessimistic about environmental taxes ever being approved in some format in the US at the federal level. Like him, I'm fairly pessimistic that the US will become truly signatory to this type of an agreement in the face and approach that it has now. But I'll finish, Carlos, by saying that in these three directions, we know a lot on the environmental front, but there is a huge gap to be filled fiscally. And as a former finance minister, I can tell you that it's always very difficult, even for good goals like environmental improvement, to go to Parliament and say, give me, triple this tax, particularly if it's very clear from research, as previous speakers have spoken, that it is largely regressive. On the labor taxes front, there is a lot of good research, a lot of consensus on what needs to be done. And perhaps COVID will push policymakers in this direction. And finally, on the global corporate tax, we have some broad agreement. We have a number of details to figure out. Some countries like the US have finally joined, which is great, but there is a lot of work to be done there. I'll finish on this note. Thank you, Carlos.
Thank you so much. And you even haven't used all the time you have available. So thank you for your capacity of synthesizing your presentation. So I will now give the floor to David.
Well, thanks very much, Carlos, and it's great to be able to join you. I'll just try and make sure that I'm sharing my slides. Hopefully that's coming through okay.
Yes. It is.
It's a real pleasure to be able to contribute to this discussion. Look, a couple of scene-setting slides, ones that I won't need to go through in any detail, because this is very much obvious and apparent to us all, that the impact of the COVID crisis, both as a health and economic crisis, but in particular, the one point I really want to tease out is its impact on public finances, which we are all very conscious of, but this is something that is going to require, obviously in the first instance, the economic recovery, but beyond that, a move towards a restoration of public finances, more sustainable public finances moving forward. Now, we think that the crisis, and we talk about the crisis and post-crisis as if there's an end to it. Increasingly, there appears to be no end to this crisis, and we hope that that's not the case, and that we can actually move beyond it at one point. But we see the crisis as being a moment in time that allows us to reflect upon our tax systems and to think about whether or not they continue to be fit for purpose for the long term. And that means that this is an exercise that requires more than just a reflection upon what do we need to do in order to restore public finances. But it becomes a question of thinking about some of the long-term structural challenges that we face and considering whether or not in that context of the post-COVID environment, do we have the tax system that is necessary to achieve what is needed? And perhaps this is also then an opportunity to build back our economies even better. Now, some of those long-term trends and structural shifts that go beyond the immediate public finance challenges, low income growth and productivity. We see accelerating digitalization and the many challenges that creates, opportunities as well. The environmental risks and climate change, the resilience challenges that emerge from that. Aging populations, our populations have been aging, and COVID has not changed that in any significant way. That continues to be a long-term challenge we face. And of course, increasing inequality, some of which we've seen exacerbated by the crisis. And indeed, the same could be said of gaps in social protection. A number of those have been really had a spotlight placed upon them in the context of the crisis. And against all of this, there is the background of countries trying to meet the Sustainable Development Goals. Now, at the OECD, we have been embarking upon work to advance our thinking on tax policy more broadly. And the central question that we ask is, what should tax systems look like in order to ensure that they are achieving inclusive and sustainable economic growth? And that really means that the objectives of growth, equity, and sustainability should be on an equal footing. We think sometimes in public finance, historically, there has been a greater emphasis placed upon growth, sometimes to the exclusion or to the detriment of considerations around equity and sustainability. We believe that sustainable and inclusive economic growth should be the objective, taking all of those elements into account. Now, in drilling down into some specifics, I'd like to begin by talking a little about the International Tax Agreement. I'll then speak a little about tax policies to drive growth or growth-friendly tax policies, and then to talk a little bit about the inequality dimension and also sustainability, and then conclude with a few observations about developing countries in particular, which I think is important to consider. Now, I won't go through the specifics of the agreement that has been reached, other than to say this. 137 jurisdictions have signed up to the agreement, representing more than 94% of global GDP. Pillar 1 and Pillar 2. Pillar 1 is very much focused on addressing this digital challenge, if you like, the ongoing challenge around the fact that the international tax rules as they stand today were largely created 100 years ago when you required a physical presence in a jurisdiction in order to be able to have an economic presence. Whereas today we know in the modern, highly digitalized, globalized economy, some of the largest and most profitable firms on the globe are able to generate huge profits in our jurisdictions and not have any physical presence. And the rules as they stand today are just not fit for purpose, and they haven't been for some time, but securing political agreement has been a challenge. And as Simeon said, we've been working on this for the best part of the last decade. So to reach a consensus-based solution is a significant leap forward. I acknowledge all of the implementation challenges ahead, but if you had said just a few years ago that you would get 137 nations, including all of the G20, all OECD, all European Union countries, to agree, firstly, to reallocate taxing rights involving, let me just quickly go through a couple of those dimensions. One, you'd introduce a taxing right based on turnover rather than physical presence. Two, that you would tax the multinational by reference to the global operations of the group rather than the separate entities. Three, that you would allocate taxing rights to the market jurisdiction. And four, that you would do that by reference to a formula. If you had said any of those things might be the subject of an international agreement, you said that just a few years ago, people would have thought that you were being quite heroic in your ambitions. And then on top of that, we have Pillar 2, which is a global minimum tax, 15%. Often there's criticism of that rate. People suggest it should be higher, but let's not forget it's an effective minimum tax. That's the effective tax rate. And when you put all of these things together, yes, noting the implementation challenges, but the fact that I can be speaking to you today saying that 137 jurisdictions have signed up to this really is an indication of tremendous progress. Now, why is this important? Yes, it's important to stabilise the international tax framework. But I actually think from a domestic tax policy perspective, and I put my old hat on as a former minister in government, if you want to reform your tax system, particularly where those reforms might impact on the average family, the average person in your community, to be able to muster the political support to do that, sorry, my light has just gone off in the background here, to muster the support politically to implement that, you at the very least need to demonstrate that corporations are paying a fair and reasonable contribution towards tax revenues in the public coffers. And that's why these initiatives, I think, are absolutely crucial. And they will put a floor on tax competition and will secure the corporate tax as an important part of our tax mix moving forward. Now, growth-friendly tax policies, I just want to pick out on a couple of elements here. I think increasingly we'll see policies that are targeted towards stimulating investment in R&D. There will be a need to improve the design of tax incentives. And some of that will be driven by the impact of Pillar 2. We will need tax policies that strengthen labour market participation. Some examples include things such as earned income tax credits, helping those often at the margins of the labour market. And I think there will be more and more focus towards achieving a partial shift away from social security contributions towards general taxation. And this is something where we see, in particular of the labour taxes, social security contributions often are much more regressive than the personal income tax on wages more broadly. And there is plenty of opportunity there for strengthening international cooperation. When we think about equity, we really see an important emerging area is around personal capital income and capital gains, the taxation of capital at the personal level. Yes, there's been a lot of focus on the corporate level, but at the end of the day, corporations are vehicles that hold funds and resources on behalf of investors and shareholders. And at the end of the day, distributions of that income and wealth are made to those investors and those shareholders. And we think it's important that we have effective taxation of capital income at the personal level. And that's something that we think has been made even more possible as a result of the advances on the automatic exchange of information, which means that tax administrations have much more visibility over the cross-border activities of their citizens than has previously been the case. We think there's a lot of scope to be made in removing regressive tax expenditures, closing loopholes and limiting arbitrage opportunities, and of course, providing income support at the bottom of the distribution, limiting gender biases in the tax system, and reducing differences between the tax treatment of standard and non-standard workers. In terms of sustainability in the environment, more broadly, we think we need to ask ourselves the question, does our tax system align with our environmental objectives? And that's not just in the context of carbon pricing and climate change, but of course, that's an important area. And in that area, we think it's important that we see a broadening of the base of energy-related CO2 emissions that are priced. The extent to which they're currently priced is insufficient. We need to increase carbon pricing to ensure that we properly reflect the true costs of behaviour by firms and individuals. We should be moving towards removing fossil fuel subsidies and creating greater cross-border cooperation to limit any of the spillovers that might occur or arise from different levels of ambition and different levels of policy stringency. And I think this is a point that Simeon was making that should be emphasised, that as part of these efforts, given that some of these taxes may have a regressive impact, that we need to have a just transition. We need to ensure that there are targeted transfers, and perhaps we can use some of the revenues generated in order to make our tax system more growth friendly, but also more equitable. And in doing so, achieve the twin objectives of that sustainability, but also in an inclusive way. A few final remarks about the particular challenges that developing countries face, which I think is important for us to consider. There are a range of initiatives that can be implemented to foster greater formalisation. That's something that should be supported. Investment tax incentives need to be improved. They're designed, particularly in the context of Pillar 2. We think there's a lot more that can be done to increase the role of the personal income tax and social security contributions, and to strengthen the functioning and the design of VAT systems. And hopefully some of these measures will not only achieve a greater degree of inclusion and equity within nations, but also across nations. But I'm going to leave my remarks there, and more than happy to join a discussion later on or answer any questions if there are.
Thank you so much. And I will now give the floor to Ana Dourado to our final presentation from today.
Thank you very much. I think you can see my slides, right?
You could.
So I will start.
Could you please try to start the slideshow? Because we are seeing PowerPoint screen. Oh, now it's okay. Now it's perfect. Thank you so much.
Thank you very much. And I will start by thanking for this invitation and congratulating you for the initiative. And following up the previous interventions, I will touch upon and briefly some of the challenges that we are facing on an international setting And I am claiming that there is only a very tight leeway for Portugal as EU member state and OECD country to go in a different direction than the one that is being designed at the international and the EU level. And this being said, I will start by showing the constraints on tax equality in the 21st century. So on a long-term or structural approach, post-COVID, and not necessarily related to COVID, we are facing many constraints that are related with tax competition as a point of departure. So taking into account that the rule is tax competition in a worldwide setting and also at the EU level, this operates as a constraint to tax equality or redistribution. And this is of course related to the mobility of the wealthiest taxpayers, including MNES. And there is another aspect that is related to non-cooperative jurisdictions, and both tax competition and how to tackle with the problem of non-cooperative jurisdictions have been at the forefront of the OECD work. And recently, as it has already been mentioned by some of the previous speakers, we are facing some trends on coordination. Some of them are based on what we call soft law, others are binding. And it's interesting to see from a state sovereignty perspective that these initiatives, they departure from the G7, the G20, the OECD, and of course the EU and the EU at a different level in terms, in legal terms for us as a EU member state. And therefore, as I said in the beginning, Portugal shows up here as a single state with a small leeway, taking into account the current situation of tax competition and globalization. Furthermore, as other challenges, we have got the digital revolution, the digital giants, the digital nomads, the multinationals, and all this has been leading to stateless income. And all of the challenges that these facts have been raising have been already showed by the previous speakers, but this is also to illustrate how huge the challenges to taxation and tax sovereignty is. And all these constraints and challenges are related to the inadequacy of the tax systems, and the fact that the current tax systems are inadequate in this century leads to big problem in terms of coercibility of taxes. So the classical concept that we used to have, that taxes are coercive, this is to some extent outdated, in the sense that the wealthiest and multinationals, they actually elect the tax jurisdictions in which they want to be taxed or not taxed. And that's where, for example, non-cooperative jurisdictions play a tremendous role. So this means, then going a bit into more technical aspects, that the connecting elements that we currently use in the international tax system, such as source and residence, do not work any longer in terms of direct taxes, in terms of corporate and personal income tax. And one question in terms of personal income tax is whether we should introduce nationality as a connecting element in order to overcome the constraints that are being raised by this stateless income due to the wealthiest taxpayers being able to choose the jurisdictions in which they want to be taxed. Now, on the ongoing measures and challenges, there is no other possibility for state jurisdictions than to cooperate. And therefore, multilateralism is a need, and it will continue to be so in terms of taxes. And contrary to the idea that we may have in common sense or as a common citizen, the national or state jurisdictions tax policy is very much guided by this multilateral cooperation and harmonization in the EU. And there has been harmonization in the last decade in the EU in terms of corporate income tax, and it is mostly related to cooperation among tax administrations and against what we call aggressive tax planning. Moreover, exchange of information and automatic exchange of information has been a must within both the OECD and the EU. And in this respect, the EU in the last decade has been playing a role that is very much linked to what is going on at the OECD level. So the European Commission normally waits for the decisions at the OECD level and then puts forward proposals of directives. But in fact, there has been harmonization and there has been coordination. So it's not really true that in terms of taxes, we are acting on the basis of single states measures. So on the challenges, still on the challenges, one of the remaining basic or fundamental measures that need to be implemented is related to the identification of beneficial owners in terms of transparency and getting to tax in terms of ability to pay. So talking about social justice and equality. And as we have heard this afternoon, we are now going through the reform of the international tax system. And this is not only about tax rates under Pillar 2, but the previous decade meant huge, gigantic work for the OECD in terms of trying to harmonize tax bases. So what we call BEPS 1.0 is now being followed by pillars 1 and 2. And therefore, there is this acknowledgement that the international tax system needs a reform so that state sovereignty remains and so that taxes can in fact be collected. Taking all this into account, one aspect that is worrying tax lawyers is related to taxpayers' rights. So exchange of information, transparency, coordination, minimum taxation, all this is going on. It's gigantic work. It's difficult to carry out. So it's what we have achieved so far. It's really unexpected and to praise. However, the next decade, in terms, for example, of the jurisprudence of the Court of Justice of the European Union, will be characterized by many referrals related to taxpayers' rights, because we are now seeing that tax administrations, tax authorities worldwide are becoming very aggressive, and therefore there is a lot of legal uncertainty, and more than that, rights related to the rule of law are being attacked. Now, on the tax principles and connecting elements, we could also state that what is orienting the work of the G20 and the OECD, and then also the EU, is the so-called principle of single taxation. So whereas initially the OECD was taking care of double taxation, international double taxation, in recent years, the focus has been on stateless income and double non-taxation. So we could say that underlying these movements of BEPS 1.0 and 2.0 is this guiding principle that income should be taxed once in one jurisdiction, and we are trying to assure that one of the involved jurisdictions will tax. Therefore, this is underlying the minimum taxation in Pillar 2 and the measures therein, the so-called income inclusion rule and the UTPR, according to which either the ultimate parent company jurisdiction will tax at the effective minimum rate, or subsidiarily, then as some kind of shift will be the source state that will be entitled to tax at this minimum rate. So this is an example of what we call single taxation, and what we would like to achieve as a fair principle of taxation. Now, taking into account what we know at this stage regarding Pillar 2, then one question, and this has been touched by David previously, relates to the role of tax incentives in research and development. Because Pillar 2 takes into account what it's called substantial carve-outs related to tangible assets, it seems that any tax incentives related to intangibles, and that is R&D, they will not be carried out any longer. So they will not be compatible any longer with Pillar 2. And as I interpret David's intervention, that's why he mentioned that we are expecting that R&D in the future will be expenditure-based. That will be also a problem in terms of EU law because of state aid rules that we have in the EU, and therefore any tax incentives in the EU under Pillar 2, and we will have a directive for the EU for the purposes of implementing Pillar 2. So any tax incentives will probably be incompatible with state aid rules, and therefore we are expecting to change the way in which we will incentivize R&D. On coordination and international coordination, Pillar 2 is an answer or a reaction to the US GILTI that has been approved under the Trump's administration, and therefore in respect of Pillar 2, we could say that it's not really a novelty of the Biden administration that we are achieving good results in terms of cooperation. So we could see that, we could say or claim that this goes back to the previous administration. In any case, although all this seems to show an optimistic leeway towards coordination and fair taxation, The issue is that Pillar 2 is not binding, and therefore tax competition will continue. And one question that we have in terms of the EU is whether the EU, by adopting a directive, possibly during the French presidency, whether this will not mean that the EU will lose its competitive advantage by implementing these measures, whereas we are not sure whether they will be upgraded, implemented in the US, taking into account the Congress, that they need the Congress to approve, to enact those measures. And there can be also a shift from the ultimate parent company to other jurisdictions outside the EU. And therefore, this is also to illustrate that there is coordination, but there will still be tax competition. I don't know how many minutes I still have.
I think you are reaching the end of the
Okay,
15
I could
minutes.
stop here actually because I was going into other aspects. But I think, let me just go to my final slide. And this is related to my position in my writings. I have many doubts on this single international standard, or on putting forward one international standard for the whole world. This is related to the fact that we have many different interests worldwide, of course, many different levels of developments, many different types of economies, and therefore I have been arguing that regional standards would be a better way to fulfill coordination and recognition of the interests of the several players. And one example that I can use for the EU is related to the pending Pillar 1. And the pending Pillar 1 is related to digital taxation, or the digitalized economy. There have been several attempts on how to enact or decide upon these rules. And I argue that there should be EU tax on consumer-facing business, a earmarked tax, playing a regulatory role so that we could, to some extent, regulate privacy, the hate speech, and some other aspects that have been related to consumer-facing business and digital giants. And this is very much related to the legal culture in the EU, the European legal culture, and it could be an example for the rest of the world to follow. I am very much more in favor, as I said, and repeating myself, to regional standards, also taking into account the interests of developing countries. And in the last final slide, these are some of my publications in which I have based my intervention here today. Thank you very much.
Thank you so much, Ana Paula. As a technical question to David, I believe that it's better to give Eva the floor. It's in a way, I think the question touches on some of the issues that Ana Paula Dourado was just mentioning, on having just a single standard and some issues related to that. So I give the floor to Eva. We have some time for this discussion.
Yes, thank you very much. It is, in fact, a more technical question, but really not. Pillar 1 and Pillar 2 at some point both refer to accounting standards as a basis in one way or the other. And there have been, especially in the US, but also in other places, there have been massive concerns by accounting scholars that accounting standards may be the wrong reference points, because then tax may have an influence on financial reporting, and then financial reporting is driven by tax concerns instead of informing the investor. And so that is a discussion that is still ongoing, and I'm wondering whether the accounting standard setters, such as the ISB or the FASB, have already said something on the issue. Did they approach the OECD in private? Because I didn't hear of any public discussion on that by the standard setters.
Yeah, look, I guess I'm not going to go into the extent to which there may have been any private discussions, but I think the question you ask is an important one for a number of reasons. And I think in particular, there is the concern about whether or not using financial statements for the purposes of determining tax liability, whether that is appropriate or not, and what might be the potential consequences of doing that, both for tax, but also for financial disclosure. I think the first point to make is to ask the question, why do we do this? Why do we suggest that you might use the financial statements for Pillar 1 and Pillar 2? Now, the simple reason is that we are really, for the first time, trying to think about how we're taxing the global operations. Certainly in Pillar 1, that's what we do. And in Pillar 2, we're having a look at what's occurring in a whole range of different domestic jurisdictions. Now, each jurisdiction has a different tax base. The corporate tax base is different in every jurisdiction. And that's because of a whole range of domestic provisions that are wholly within the province of the sovereign national government. Now, you have essentially two ways to overcome that problem. One is you get everyone together to agree on a common tax base. And I think if the European example of the CCCTB is anything to go by, then that's probably not going to be a promising endeavour. The other option is that you acknowledge that those differences will exist, but you look for a more standardised basis upon which these matters can be determined. And financial reporting, because of the extent to which there is some harmonisation globally, and you know that's not entirely the case because of IFRS and other accounting standards that might prevail in other jurisdictions. But by and large, there is a basis upon which a consistent approach can be determined. Now, what might be the implications of that is a good question. I guess one of the things that I think, and we are very alert to this issue, and we recognise that there will need to be very careful consideration as the detailed rules are developed to ensure that there is not any room for abuse in this respect. But what we would say, what we would say is that one of the things that I think is a little reassuring is that for the purposes of tax, often firms like to reduce their profitability. For the purposes of disclosure to the market, there is a very strong incentive to not suppress your profitability. So we think that the incentives are pushing in different directions, and that is a useful dynamic. It's better than having a situation where there is an incentive to push one way or the other. Now I can see, Eva, you're shaking your head, so there's obviously room for differences of opinion on this. But the reality is that if you want to have a common basis, financial reporting presents an opportunity for that. It's not without some challenges, and we think it's important that we're alert to those, and as part of the detailed rules, that we do what we can to mitigate any of those potential issues.
Okay, thank you very much. And I agree there are several there is so much to do in the detailed rules, but this is probably not the place to discuss this. So I'll leave it at that. But thank you.
Thank you so much and we are perfectly on time to pass the floor to Miguel Santobin, who is also a colleague of mine, is a member of, as he was already presented, as a member of CFP, and he will close this seminar that I think it was quite interesting, and I think all of you have gave us very much insight in what is going on, because as I said before, we economists tend to use the tax system for a lot of purpose at the same time. So I give the floor to Miguel.
Thank you, Carlos, and thank you all for all your contributions. They were, at least to me, very interesting. I've learned a lot, and I think you've complemented each other somehow, and without repeating ideas, one could understand there was a common ground. I was listening carefully. I don't know if I understood everything because some parts were rather technical. This means that we'll have to study these matters harder. But there are some topics which came to my mind, and probably it would be interesting for you to hear from the audience, as I was part of the audience. I would start that there was this important idea that there is a very important role for government in the post-COVID era. This was somehow common, and because of health, because of aging, because of climate change, because of inequality, because of growth, somehow all this calls for some kind of government activity. And if you have government activity, then you have to finance government activity. And if you're concerned with public finance sustainability, this leads directly to taxation. So the importance of taxation is there, at least for this reason. But then, perhaps more important, taxation has a strong influence on behavior, on economic behavior, on social behavior. And this, coupled with the challenges in this, I hope, the post-COVID world that will come soon, if this gives, say, a role for tax policy. There was an interesting an interesting idea which came from Eva, at least to me. This was the importance of trust. And I found it very interesting how it is important that, say, the taxpayer trusts the tax administration at a micro level, and how we made studies on that, and on the way one looks into the tax administration as someone who you can trust and who is independent. But then you also have to look into a government and into the public administration, have somebody that is doing what is right and what is what is in the public, what makes sense in public purposes. And here, I think there quite a number of speakers made this point that, one, you have to act decisively on the environment and global change, and so you have an important part of tax policy that is concerned with that. But second, this is regressive. And here you have, I think, a problem. You have a problem because you have to do it, but then you want to have trust from the taxpayer if this is too much regressive. People will be, in the end, they may be against it if they feel this is not just, this is regressive. So, and this was a point, I think it was made by David, also by Paulo and other speakers. You have to have some kind of countervailing mechanism. You have to have another part of tax policy that is concerned with inequality in distribution. I think David made some interesting points on that, on the details, on part of details on that. And I took some notes on the importance of how you tax labor income, how you tax the second labor income, what you do about the market participation, things like you should have general taxes. You should not make great differences between standard and non-standard labor income. Probably you have to tax more personal capital and property and so on. This is one part, so inequality distribution. Then we have the part of international coordination, and here we had some speakers. For instance, Ana Dourado was mainly concerned with all this part of international coordination. It comes both from goals, because goals are international. For instance, climate change is not specific to one country, and also because of tax competition, which arises from the globalization and because in fact factors of productivity and labor and capital are highly mobile. And for instance, I retained the idea from Ana Dourado that a country like Portugal has a small leeway in devising a tax policy. It is highly constrained by everything that is happening around. So there is no great point in doing this alone. You have to have international coordination and the importance of those international tax agreements. But however, I also took note that an experienced person like Yankov was highly skeptical about that. And so it seems that we will have some difficult decisions to make in the years ahead, because first you have to have international coordination, but this is difficult. You have to have something about climate change, but what you're doing is not enough, and this is regressive. And then we have to deal with income inequality, because this is a goal in itself, and because you have to have trust in governments. And to make sense of all this is, I think, difficult, but life was not easy in any time. So I guess it was an interesting session, because we've devised the problems and some kind of solution to them. Thank you. This is my reading, my understanding of this, but I have no more details. Then I would have to read your papers to comment more. Thank you, and thank again for coming to this online session. I wish next year you could come to Portugal or to any country you want without restrictions.